I think we're working now. Welcome. Sorry for the delay. 105, not too bad. Could be worse. The microphone could be off. Oh boy. All right. Welcome everybody. So my name's Jay. Oh, welcome to Jay's Corner. I'm not going to be long today. We're going to try to go quickly because it's Friday. And it's probably, the only time of the rest of the week. I don't think I have time for the weekend. We've got some other big announcements and things like that, in the works. Trying to keep myself out of trouble, as usual, with varying degrees of success. Okay. So I said last week, I said last week that I thought that this was going to be a very crazy week. And of course, the world delivered, not surprisingly. That was not a surprise at all, because we just had the setup. And this is about setup, right? This is always about setup is the reality. And I'm going to just, what am I going to do here? I'm going to go to the archive. So this is the archive of Jay's Corner. And by all means, please, everybody, to the degree you can. I don't expect everyone to get all of the information at once in one video. It's almost impossible, right? I've had decades of experience at the most complicated end of financial markets. Literally. I can safely say that, without getting too far into the weeds. Right? The idea of a single security is just of almost no interest to me. It does not register on the complication scale. And this is not a flex. This is just reality. And so what I'm trying to do is trying to give you basic intuition so that we'll of the noise that you're hit with. And there's a tremendous amount of noise. There are motivations to keep your ears distracted and your mind distracted with that noise. The problem is when you get distracted by that noise, and those are the narratives that you cling on to wrongly, then it comes to the consequences are yours to bear and yours alone. And there's when I have a problem. Okay, so as I said, unhappy here was here. That, unhappy talk is here, right? Earnings seasons on the Fed here this week. And what's left out of here was the GDP report. And in fact, yes, that almost universally was delivered. And basically people would ask me can rightfully ask me, well, what did we have? What we had is Apple, Google, Microsoft, Facebook, General Motors, Ford, 3M, McDonald's, kind of all out there reporting quarterly earnings. And it is natural to get the headlines. It is very natural to get the headlines. That's what is interesting because you can identify with what that stuff is. But the reality is, if you understand Jay's Corner, this has always been stocks for show, bonds for dough, meaning that the big market's controlling the small markets. And if you understand the big markets, you would have understood that is R down here, the denominator. And for that reason, this week was so important because at the time that all the information was coming up about the numerator, what we saw was other information influencing the denominator. And what I would describe is you had incredible crossfire of both the numerator and the denominator. But I try to tell persons all the time is let's just make sure that we have understood the denominator and the building blocks first. This is your cornerstone first. And you can see this formula here doesn't say net present value of stocks. This is your house. You own rental income. What is this? Yeah, you've paid rental income. You've paid for the house, which is the minus C. You get rental income, which is the C on the numerator. But oh yeah, by the way, you've got to pay this stuff back because you have a mortgage. Maybe you've mortgaged to buy this Airbnb. In other words, every financial exercise is this. And the valuation of it is this. Well, what has happened to be? What has happened to be, and I realize that, before we get to the point with some precision about, kind of where I'm talking about, let's just take a look at over here. What you have basically had is a denominator which has been one-way train, directly lower, and almost completely stable in that direction. So you've had basically the perfect situation. Uh-oh. What's going on here? Okay. It's not the internet, I hope. That'll be a problem. I'm going to shut some stuff down. If I'm even broadcasting whatsoever. That's a good question. Let's just see for a moment. It's always something, as you know. No, we'll be fine in just a moment. We'll be fine in just a moment. Yep. In fact, we are. So let's just, maybe a minor glitch. Preview of where we're going. But, we do not have what I am looking for. There we go. Okay, we're back. So let's just take a look at the bond market here. What we have had, what I would call this, much of the reason why most of the distraction has been always on the numerator has because if you take a look back here, we've had a one-way train. We've had a one-way train. And here it is. We've had this lowering low rates environment for a very long time. And you can see how low it has been over here. Well, now all of a sudden it started becoming unstable and to the upside sharply. And this is what I would have been saying for months, which is that if you look at the archives here, this had gone back all the way. And this is Jay's Corner. These are the archives of Jay's Corner. Inflation takes no prisoners. And so now we've become adjusted. And this is why I would say that this is the first quarter. Right? So this is where we've been. We've had to adjust to the fact. We've had to adjust to the fact that the denominator is no longer stable. It's both higher and unstable. This instability is a matter that I am going to say both. It's not just one, but it's both. So in addition to in R being higher, it was also moving around 15 basis points a day. The reality is that it comes almost, if you can see as we get to narrower days, you can see now this range, while still moving around, if you take a look at the past month and a half, something that I've noted, this range has now biased to flat to lower. And that has then opened the window. It opened the window back to attention to the numerator, meaning that the denominator stopped moving around. which has allowed persons in a way to go back to portfolios in the top of the fourth inning. Right? The first three innings, it was so volatile because of the inflation and people becoming accustomed to what this was, that, oh, this 9% isn't transitory. But now, over, as you can see from this graph here, you've seen now lower, and you could see lower, and we're limited, but you can see it from here. After we've spiked, we've had notably lower. What would have happened if you can see by the NPV formula? You don't have to be a mathematician, right? Just push down your R lower. See what happens. NPV higher across the board. And so while we're dealing with inflation and bad headlines and, gas at $5, if not more, really what was going on is interest rates far more stable. And you can see it here. You can see up on your screen on the 10-year yield. This has been going on for pretty much 2 months. In other words, the first three innings, you've had this sharp drop in equity because you had a sharp rise in R. But after that, we've seen bouncing around within this range. So then it basically came to the words of this person here. All eyes on Chairman Powell this past week, Tuesday. And I would tell you that, this, as Jay's Corner has said, this is a very unenviable job, having to walk a tightrope. Nevertheless, and on top of that, I would also say that I don't think that this is Jay's opinion. No one's asking Jay. I'm just a guy. I would also say that he has not necessarily performed well in this setting until this past week. Less than confidence inspiring, but it stopped here, almost on a dime.
Pressures declining. Do we see actual readings of inflation coming down? So in light of all that data, the question we'll be asking is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target. And it's also worth noting that these rate hikes have been large and they've come quickly, and it's likely that their full effect has not been felt by the economy. So there's probably some additional tightening, significant additional tightening in the pipeline. So where are we going with this? I think the committee broadly feels that we need to get policy to at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting. So I think the median for the end of this year, the median would have been between 3.25 and 3.5. And then people wrote down.
Let's just see if.
So said that we expect ongoing rate hikes will be appropriate, and that we'll make decisions meeting by meeting. So,
and there it was. I happened to go right to it. Meeting by meeting. Chairman Powell stopped making promises and stopped giving you a number in advance. And the markets took it as they heard what they wanted to hear, right? What did they hear? They have seen the market more stable and lower in interest rates, and they just wanted to hear that was not going to be continuing to spike higher. And from there, what happened? Lower in rates, allowing what? Allowing back to the numerator, and what ends up happening? Focus in, and off we went in equities. Very simple. Off we went in equities. Now, to persons who are sitting here who have watched Jay's Corner, over time, you've known that, I'm not out here telling you with a crystal ball where I think the market is going, but rather that the market is basically trying to is a mechanism to decide the open market price of my glasses case. My coffee mug, my Winnie the Pooh coffee mug in prior broadcasts. That's all it's trying to do. So what these videos have been showing you, broadcast in different form with different levels of success perhaps. But what it's been trying to do is in fact show you then something different, which is of course my second, very, very used diagram. Is that every point in time you're at the red arrow, every point in time, including right this moment. And simply my observation has been that, look, because of misunderstanding, what we know is lack of knowledge about the way the interest rate and foreign exchange markets and how much bigger they are than the numerator. Because of that, and because of the fact it was more volatile, not only level, remember I said two things, so more volatile, that what happened is that curve over on the far right became flatter. That's it. So then from those building blocks, you then get to the next step, which is, okay, where's the debate? What are the parameters of the debate that the market is showing you that it has? And here it is, which is every bit here, right, revealed. Throughout Jay's Corner, I'm not going to scroll through every single possible entry. But actually, what I have been doing is showing you outlines, and you can see it here, and you'll see it here today. And you'll find it almost of zero coincidence. This is a long-ranging chart now. This is April of last year. See these little wicks here, these little thin lines on the far left? Oh, you mean that in up markets, when this lattice gets stretched to the upside, that in fact it happens to find these little areas of congestion where the debate was the hottest. Oh yeah, and by the way, we had to touch that sometime during the worst in March. These are not coincidences. They are not. Because while people misunderstood, like I said, as I've said multiple times, frequent followers of Jay's Corner are tired of it. You'll be patient, please, because there are newcomers. And this runs against the grain of when you watch, CNBC Fast Money, which is full of very qualified people. By that same token, like I've told somebody the other day there was 15 minutes on Tesla versus Twitter. 25%, the first 15 minutes was Tesla versus Twitter. That has nothing to do with the way that the Swiss National Bank manages their global portfolio. Back here. So once you had lower interest rates and more stability, and the Federal Reserve Chairman now telling you, look, we've raised rates a lot. We're going to take it data by data. What did you end up happening? Now, why the tremendous rip higher? Why the tremendous rip higher? Well, and now you can see the tongue-in-cheek here. Let me just see if I can shut down this lattice. And now you understand this video.
I can keep a secret if you can.
Oh no. I guess we're going to have to pass. Any excuse that I have to show a Pulp Fiction excerpt, I try to sneak in. Also with, the Cowboys or the Wolverines, but, those aren't universally as admired, I don't think, as Uma. Anyway, what I'm going to point out is basically this.
Do you want to hear my Fox Sports 5?
Ooh, we still have a chance. This is right.
Sure. Except I think I'm still a little too petrified to laugh.
No, you won't laugh because it's not funny. But if you still want to hear it, I'll tell it.
I've only watched this after 50 times. I laugh every time.
3 tomatoes are walking down the street. Papa tomato, mama tomato, and baby tomato. Baby tomato starts lagging behind, and Papa tomato gets really angry. Goes back and squishes him. Says, ketchup. Ketchup.
And there it is. And you may try to make it lots of complicated stuff. But literally that can be it. So now, right, I'm never the person to say that, I have the holy grail of information, etc., etc. What I've not revealed anything that's not out there. Whether or not you've seen it organized or explained in this way, that is different, right? Try to distinguish myself in that way. Very unlikely to be making it up. But now I made this point, what was this? On the 20th. The world was set up to thinking that the world was going to end. Right? In other words, other persons running portfolios, you could see it. Extremely light positioning in equities. My point was, yeah, but the euro stopped crashing, right? The euro went down to parity, went below parity at the worst 2 weeks ago. That for now has stabilized. We'll get to that at the end. It's one of the reasons I'm only one of. It may be the main reason that I only calling this the middle of the 5th inning. We'll get to that in a moment. And this also is the long bond, which is not the rate, but the actual level of fixed income instruments, meaning bonds move in inverse relationship to, the denominator. So the R went down, bonds went up. So now you have $100. You're allocating bonds versus stocks. You go, do I want to pay this for bonds? No. So what do? You buy stocks. So in other words, when you combine this and you combine more stability in the big numbers, you get UMA, catch up. So none of that then should have been a surprise. It's literally that all I was doing here so far is to show you, okay, how far could this extend up in the situation? In the situation, you get out to one of the far ends. And we got it. And we're the experience level on the planet, right? There's no such thing as coincidences. That doesn't make it a great year, right? It still has been difficult. And you can see, though, how I've explained things in Jay's Corner. This is, for readers, they've seen this. This is the targeted retirement fund at Vanguard. As of last night's close, minus 13.85% for the year. This is the best in the world, right? This is not me throwing a rock at Vanguard. Absolutely 100% not. Would never do that, right? I have zero doubt they have unlimited computing power to create diversified portfolios for persons in this age division. I didn't say that after the fact that it was correct. I'm saying that in advance, do they have the academic chops to understand how to put them together? Yes. We'll get to my point on that in a few moments. So you can remember minus 13.85. This is BlackRock. a very close neighbor of Vanguard. Same neighborhood, right? Minus 13.85. Down to the penny. Penny. On $1,000, they're both down 13.85%. It is not about scope and scale of 13.85 that I'm pointing out. That is not pertinent here. What my point is to you as private people is this is the margin. That tight. That exact. The professional market is examining stuff. I've pointed this out in other broadcasts, right? This has varied between what? 0.2%, 0.4%. All the things that have gone, sideways, up, down, with 5 different personalities in, depending on the nanosecond. 2 largest unlimited resourced groups spot on to the penny of each other given this parameter of the 2040 targeted fund. We're going to take a slight break here. The reason I bring this up on a Friday is because I'm talking about Mr. X. That's the punchline. I've revealed it. That I'm going to show you these 2 other videos. So what is not important to me is the fact that you're here. So this is now, right? Let's just call yourself minus 13.85. So what does that make you? 86.15. Right? My point is here is that, okay, if we have these other layers in a comprehensive plan, you could have taken this. Maybe. Depending on who you are, your age, your circumstance, what these numbers look like to you. Why does Jay whine on about making sure that and being so retentive about healthcare costs? Meaning to be insured so that you don't have minus 10 here. Not minus 10%, right? Minus 10. Right? So this is not a surprise to anyone. Should not be a surprise to anyone part of Jay's Corner, right? Right? I'm talking about minus 10. I can't have this. Because where you're going to get this minus 10, you're going to get it out of 86. And now you're at 76. It gives away the time that you could have used. Sorry about that. I'm going to try to move the window just slightly. The reason that I've written Maximize Your Medicare, the reason I'm talking about the Affordable Care Act and the APTCs, et cetera, is so that you don't encounter this in combination with a lower portfolio value in your investment retirement savings plan. The reason I'm bringing it up right this moment is the following. Is that this number has been down to 80. That has happened this year. So if anything, this could be a reprieve to some. You may not feel like it is, it still may be. And the reason I'm bringing this up is because of these two other slides. So this is the thumbnail to other videos on this channel. Annuities and Retirement Miracle, which is life insurance as a retirement tool. Does it work and how? I would stress and encourage people after this video is over, please don't skip over to them now. These are important videos because they're describing possible ways to put money into the yellow. Now, we would know, well, you can probably glean that I'm god awful at sales. From me to god awful is probably an upgrade, right? But really, my point here is this is the spot. Now, I find this the opportunity to the degree that you can find that minus 14% to be an opportunity. In the context where everything has, lots of things have gone quite negative. That one thing that has gone positive is that while interest rates are lower today than they were 2 months ago, something that I just said a few moments ago, the fact of the matter is that the interest rates are notably higher than they were 2 years ago. And the reason that that is important is because those are in there's a delay in this, and I apologize to you for that, right? Which is that, there's a delay to this, but this is the input, the level of interest rates here is the input. So you can see it's lower. I hate these pop-ups. Lower for the days, but you can see here notably higher than 2020, 2 years ago. Notably higher. 2% higher. Well, why is that important today? The reason it's important today is because those are inputs into these instruments. Those are inputs into annuities today. They're inputs into the life insurance video that I showed a few months ago. Meaning that the return then, the guaranteed returns inside these yellows has improved. No doubt. And I get emails every day from all the different carriers and sellers. Hey this, hey that, hey this, hey that. And there are more technicals, right? Way beyond, candidly. It's a little worrisome to me. I'll just be very candid with you that other representatives are trying to just gloss over certain other of the mechanics inside of these instruments because they are not child's play. No, it is not simply, oh, well, it goes up if stock market goes up or it goes down when the stock market. No. It's way more complicated than that. Much more complicated than that, beyond the scope of today. But my point is that in general, that both of these instruments now are yielding higher numbers to those persons who want to reconsider these layers. I needed to swerve here because this is why I'm, created Jay's Corner. This is the point of the second book. Right here. Which is, I could have, as you can see, this portion here is pretty difficult to call. Right? Because the reality is the following. Is that if you can tell me with precision when it's up and when it's down, you don't need a diversified portfolio. You don't. You just need to be right 5 to 6 times in a row. In which case, you put 100%. Oh, no. In fact, no. You go to the bank, you ask them how much you can borrow, you borrow it from them, and then you put it all on this first time in a row. And then you put the entirety amount the second time around. By the 6th time, $20,000 is more than $1.2 million. Right? Because it's just doubled 6 times in a row. Which is not coincidentally, right, why I made a video, which is the you must be bleep kidding me. Right? Because people try to use the mentality of, well, I got it. I'm right because on Bitcoin I just did this and then that and become a millionaire. Well, no, actually you could have just done it this way. In other words, if you're going to call direction right in absolute terms, you can always win. Always. Right? And you don't have to be right a ton of times. But you got to be 100% right. And of course, that's ridiculous Or, maybe if you have a crystal ball, it's not ridiculous. But in the absence of a crystal ball, what do you have? You don't have this, right? You don't have a crystal ball, let's just say. And so what do you end up having to do? You end up having to rely on this in small time frames, which then turns to this in multiple time frames. When you add those together, what do you get? You get, let's think through all these different layers. And now you've changed it because now you're not 61. I put up 61 because the APTC, the prior video from yesterday's live stream, go and find it. I'm sure you can find on Jay's Corner and on Maximize Your Medicare, affecting both groups for different reasons. Brand new information this week. It's been a crazy week. That is to drive down these numbers here so that you can have bigger numbers up here over time on stuff you don't necessarily control, on things that Happy Talk has told you, your Joe Broker has told you, I told you I can pick Twitter, I can pick Apple, I can pick, well, that same person also pick Facebook, right? So, I bought Apple and I shorted Facebook. Okay, yeah. If you've done that with certainty and regularity systematically, you don't need a diversified portfolio. You don't, right? You just everything goes on that position. Simple. For the rest of us, we've got to rely on kind of this framework. And these other elements so vital, because Jay does not care about necessarily one. Well, don't get me wrong. I care about this minutia to degrees that you should not try to replicate because you don't sleep well at all, right? But most importantly, my point is this pumpkin stuff. Right? I'm trying for the highest possible summation of all of these rows. That's our guiding principle. That principle and that alone. The fact that I have command over, this, that, and the tax efficiency of this, that, and the other. Okay, well, if somebody's going to criticize me for that, okay, I'm going to have to live with it. But the point here is that while it looks and feels like I'm telling you all sorts of things about, interest rates and bonds for dough and the fact of, the negative convexity of mortgage-backed securities and, asset-backed securitizations, all of which I could have told you, which I have not told you because there's no audience. I've lost every one of you, but just by those two phrases. Right? That we need to focus on the green. How do we do that? Try to make each one of these rows as good as it can be, but understanding that the fit together is the key. And what I'm telling you now is that the interest rates higher has created a situation where these couple of add-ins here, which had too low an interest rate because interest rates were too low, now all of a sudden have flipped. Not all of a sudden. It has flipped. And by the way, I'm going to tell you this, and this is a little crystal ball bit, which is that if we stay here and continue to go lower, the opportunity in these two elements is going to go away. Because what has happened here is interest rates lower, and that's what's driving better. Interest rates went higher, driving higher rates in annuities and life insurance inside the guaranteed portions. Well, guess what? That's now reversed down by 100 basis points, a full % from the high. There's a lag time, and this is your takeaway. on why these two videos are good, and we're not going to repeat them. But my point is that the inside the guts here is interest rates. And right now, there's always a lag time between the market rate and what's in here. Well, what's in here right now looked back at interest rates from a few months ago, which is now gone. So I'm saying that if that sounds like the time is now, there's a reason for that. The time is now. If you're looking at it, if you decide that it fits inside of here, then this is the time for this video, and to understand the implications. Absolutely. Let's move on. You're not here for that. Thank you very much for your patience. Here's what I would tell you. Let's say it was a year ago and you went into a cave. What has happened? War, interest rates much higher, Euro to USD down 20%, and the yen down worse. You candidly speaking, you'll have Americans being tourists, not the other way around. Right? An American vacation is now this much more expensive in their domestic currency terms. You have inflation at 9%. And this is the reason that, candidly speaking, this is the reason I can only call this the middle of the fifth. None of these are resolved other than interest rates much higher. This seems to have been abated, which is, of course, very important, very good. There's a reason I said stocks for show, bonds for dough, right? Because that's the one at least some people kind of think they kind of sort of understand. Even fewer people understand the dynamic of foreign exchange and how much bigger it is. A lot of the turmoil in equities about a month and a half ago, there's a YouTube short that I created about risky assets for sale, was about the fact that overnight the Swiss National Bank hit the sell button 2 days prior to triple witching in the third Thursday of June, and I don't remember what date that was. That if somebody in a foreign currency wants to repatriate their money that was invested in dollars, which is now appreciated, right? While euro is down $20, that 20%, that means that the dollar compared to euro is up by 20%, right? It's just the flip side. So my point is, Swiss National Bank just sells Apple. They don't care about Apple price. They care about the 20%. They care about the 20%. To them, they get more euro back than they put in. A lot more. They got the dollar appreciation, and then they got the translation back to their European currency. Both. They did the rational thing. If the biggest holder hits the sell button, guess what? Your 5 shares are going lower. Right? Very simple. It's the other analogy that I've said. Richest person in your neighborhood owns 3 houses. That person has some personal or a tax problem, has to hit the sell button. Guess what? Your house in the same neighborhood has declined in value. The end. Right? You don't have to know too much more. I have nice shrubs. Doesn't matter. Doesn't matter. I just repaved my drive. Doesn't matter. None of it matters. Right? And that's my point. Is that this turmoil over here, I just can't see is over. We just cannot have this. We're over here, what do you have? Well, I guess I'm showing it to you today. Of course I'm showing it to you. Certain things that certain people say, including myself, are just kind of like, why did you have to say this? Look over here on the right-hand side of the screen. It's not only stocks that are higher today and over these past weeks. Not trivially. This right-hand panel is commodities. So the same thing that has ripped stocks higher, lower interest rate, stable euro. If they go the other way, what does that do? What people don't pay much attention to is the fact that this panel on the right-hand side is denominated in US dollar terms. And sneaky here. Oh, well, we've had peak inflation. Peak inflation. Inflation's dead. Gone forever. Oh, yeah? Dr. Copper, in a week. And this is not it, actually. Let's take it back 2 weeks. We've gone up by 40 cents with the denominator of $3.15. Copper is up 15% during this time that equities have risen. So while people are parading around saying, oh, well, inflation's better, see, the bond market has told me this, that other markets on commodities, for example, are also now denominated in dollars, and because of the fact that they're denominated in dollars and the dollar is off the high, meaning the euro is off the low, and then now what do you have? Yeah, you've seen oil lower compared to 120. That's true. You've seen also oil a lot higher than 90, or where it was 2 weeks ago. 90, you can see it here. 93. You can see it here. Even low, it'll be lower, 92. You've had sneaky higher. You've had sneaky higher. And oh yeah, by the way, equity markets did tell you, one sector did tell you this in equity markets. So, and here it is. The only still year to date higher, and you know, this is just slowness of this website. You can see it here. Apple, nothing. Apple. This is 66 to 78 since pretty much the time that I was set out catch up and talking about the fact that bonds were more stable. Well, this spike here can be attributed to that stability here, and because of the fact that things are denominated in dollar. So the idea that this stuff is over can't be. It's not logical to say that it can be. So while I can understand that people are going to be saying, you know, we're going to see some happy talk over the weekend. We're going to see lots of happy talk over the weekend. Perhaps what we should just say is that all we've done is on a much flatter curve on the right, that we've extended out to one of the tails on the upside, which has happened to, right? And I put that in air quotes because if you followed what I've been saying, that this was possible in the up scenario, absolutely. Right to what? A congestion zone and a debate. Here we are. What do you do about it? Unclear, because it depends on how you fit, how these numbers now, because now let's just blank these into plain. My point here is, okay, you're sitting in this area here. The question is, Now you're at these new balances, whatever it is. This is today. And we'll just put don't know. TBD. There we go. Yep. My point is this number used to be 80 just 3 weeks ago. Maybe you're there saying, okay, 86.15, you know what? I have these other layers. I'm sure that's wrong. That's right. Anyway, my point is that if these balances here support your ability to stay here in this number, okay. And let me shut this down because I didn't show you this whatsoever, did I? Let's see. My one snafu. Not too bad. But you can see here, we're here today. It doesn't matter what your age is. You're 31. This number is now your set of circumstances different. You're 31, as I've said in the past and in this newsletter, I've said, when we were down at 80, I was saying, like, look, if you're 31, you're like a senior allocation, riskier stuff. Because why? You have more time. You have more time. Oh, you mean you have more nodes on this lattice? Perhaps. Right? So I'm not going to tell you, which I refuse to do. There's a reason for us not saying financial advice. But really what it is okay. We've gotten a break. We've had catch up. Right? We've had Dr. Spock. My second other favorite.
An ancestor of mine maintained that if you eliminate the impossible, whatever remains, however improbable, must be the truth.
And that's what I was saying. If you add what I was saying, which was to say, okay, everyone thought the world was going to end. Europe was going to blow up that day. We're going to have like national revolts left, right, and center. There are food riots. You could probably see that if you Google it. Didn't happen. Then what would have happened, especially when you had this? Catch up. And how did I come to that conclusion? Dr. Spock told me. From there, now we're here. Now the question is, are you fine with the fact that we are still ultimately back to the red arrow? And now you can hopefully see the pieces of the newsletter, the channels, why I talk about Medicare in the way that I do, etc., kind of fit together. It's not coincidence. I have an alarm that tells me I've been talking for an hour. That sounds like a good breaking point. Questions, comments, feel free. Please, everyone. The Substack. Like, subscribe to the channel to share with others. I promise you that, happy talk about the numerator and the fact that, I cherry-picked Apple, which has grown only 2%. 2%. It's being rewarded in this way. Right? So my point being is that that's all fine and good as long as we have these other components in your understanding of all of the way that finance works actually, so that you don't get pushed off the track by happy talk and all of the noise.